Ever wish you could predict when the stock market is about to crash? While no one can see the future, there are warning signs that often appear before a big drop. Today, we're breaking down the key indicators investors watch, like rising debt, overvalued markets, and sudden shifts in investor behavior. By the end of this video, you'll know what to look for, how to protect your money, and why spotting these signs early can make a huge difference. Today, we will talk about warning signs of an upcoming market crash. So before we start, make sure to hit the like button and subscribe to my channel. 1. Market crashes. A market crash is a sudden, sharp decline in the value of financial markets, often triggered by panic, economic imbalances, or external shocks. While crashes are sometimes unpredictable, history shows that certain warning signs often appear before major declines. Understanding these signals is crucial for investors to protect their portfolios, minimize losses, and plan strategically. Market crashes impact not just stock prices, but also bonds, commodities, and global financial stability. Beginners should recognize that crashes are a natural part of market cycles, often preceded by imbalances in valuations, investor behavior, or economic indicators. Awareness of warning signs allows investors to act cautiously, adjust risk, and stay informed about potential downturns. By observing patterns rather than reacting emotionally, investors can navigate market uncertainty more effectively. 2. Excessive market valuations. One of the key warning signs is overvaluation in the market. When stock prices rise far above their fundamental value, it creates a bubble that may eventually burst. Metrics like the price-to-earnings (P/E) ratio or market capitalization relative to G/P help identify overvaluation. High valuations can indicate that investors are overly optimistic and willing to pay more than assets are intrinsically worth. Historically, extreme overvaluation has preceded major market crashes, such as the dot-com bubble in 2000 and the housing market before 2008. Beginners should understand that while markets can remain overvalued for a period, excessive valuations increase the risk of a sharp correction. Recognizing this warning sign helps investors evaluate portfolio risk and avoid chasing unsustainable market highs. 3. Rapid credit growth. Credit expansion, particularly through borrowing for investment or speculation, often precedes market crashes. When individuals, companies, or financial institutions take on excessive debt, it amplifies risk. Rising leverage means that even small declines in asset prices can trigger forced selling, creating a chain reaction that accelerates market decline. Historical examples include the 2008 financial crisis, where over-leveraged mortgages contributed to a systemic collapse. Beginners should monitor credit conditions, debt levels, and lending practices as potential warning signs. Rapid credit growth can indicate that investors are taking on unsustainable risks, increasing the likelihood of market instability and sharp downturns. 4. Investor overconfidence and speculation. Excessive optimism, speculative behavior, and herd mentality often signal an approaching market crash. When investors ignore risks, focus solely on short-term gains, and chase hot trends, markets become vulnerable. Speculation drives asset prices above intrinsic value, creating bubbles. Social media hype, news frenzy, and financial commentary can amplify this effect, encouraging mass participation in overvalued assets. Beginners should be aware of these behavioral patterns and avoid being swept up in market mania. Overconfidence is a subtle warning sign that markets are overheated, and recognizing it can prevent impulsive investment decisions that lead to losses during corrections. 5. Economic slowdown indicators. Market crashes are often preceded by weakening economic indicators. Slowing GDP growth, rising unemployment, declining consumer spending, and reduced corporate earnings signal potential trouble. When the real economy shows stress, financial markets often react negatively, especially if investor expectations were overly optimistic. Monitoring economic reports, central bank actions, and global trends helps investors anticipate potential downturns. Beginners should understand that markets are forward-looking, often reacting before economic conditions fully deteriorate. Recognizing early signs of slowdown allows for portfolio adjustments and risk management strategies before a crash occurs. 6. Rising interest rates. Interest rate hikes by central banks can trigger market corrections or crashes. Higher rates increase borrowing costs for individuals and companies, reduce corporate profits, and slow economic growth. They can also make alternative investments like bonds more attractive compared to stocks, causing shifts in asset allocation. Rapid or unexpected rate increases are particularly concerning, as they may prompt sudden market reactions. Beginners should monitor central bank communications, inflation trends, and interest rate movements. Rising rates, especially after prolonged periods of low borrowing costs, can signal tightening financial conditions and increasing market vulnerability. 7. Declining market breadth. Market breadth refers to the number of stocks participating in a market rally. A healthy market rally is supported by broad participation across sectors. However, when a few large-cap stocks drive gains while most stocks lag, it indicates underlying weakness. Declining breadth often precedes market corrections, as the market becomes dependent on limited performers. Beginners should monitor indices, sector performance, and advanced decline ratios. Poor market breadth is a subtle yet powerful warning sign that a correction may be imminent, as the rally lacks broad support. 8. Geopolitical and external shocks, wars, political instability, pandemics, or natural disasters can trigger market crashes, especially if combined with economic imbalances. Geopolitical tensions increase uncertainty, reduce investor confidence, and disrupt supply chains. Sudden shocks often lead to panic selling, amplifying declines. Beginners should stay informed about global events and consider potential risks to diversified portfolios. While such events cannot be predicted precisely, understanding their potential impact helps investors prepare and adjust risk exposure, mitigating losses during sudden market downturns. 9. Volatility spikes. Sudden increases in market volatility, measured by indicators like the VIX, often precede or accompany market crashes. Rising volatility reflects fear, uncertainty, and rapid shifts in investor sentiment. Frequent large swings in prices indicate instability and potential for sharp declines. Beginners should interpret volatility as a signal to review risk management strategies, diversify assets, and avoid overexposure to high-risk positions. Monitoring volatility trends can provide early warning, allowing investors to make informed decisions before panic spreads throughout markets. 10. Preparing and responding to warning signs. Recognizing warning signs does not guarantee timing a crash perfectly, but it allows for strategic preparation. Investors can diversify portfolios, maintain liquidity, reduce leverage, and adopt a long-term perspective to weather downturns. Avoiding panic selling and sticking to disciplined investment strategies ensures resilience. Beginners should combine awareness of valuation, economic indicators, credit conditions, investor behavior, and geopolitical risks to develop a comprehensive risk management plan. Preparation and knowledge allow investors to protect wealth, capitalize on opportunities, and respond calmly when markets become unstable, turning potential crises into manageable challenges rather than disasters. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.